Second quarter performance for 2023 came in better than expected. In the United States, despite some of the residual banking challenges from the first quarter, the S&P 500 continued to climb. It has now gained approximately 20% off of the lows from last October. When we look to the international markets, here too we've seen strength. Japan, a market that has somewhat been underperforming over the last number of years, has recently hit a 30-year high, contributing to the strength in the international equity markets. In Canada, the TSX Composite Index has lagged its global peers due to lower oil prices and weakness out of the banking sector. When we turn our attention to the fixed income markets, what we've seen in the second quarter has come as a little bit of a surprise. We felt at the beginning of the year that we were at peak interest rates. Nonetheless, the Bank of Canada provided a surprise interest rate hike to its overnight rate in June and has indicated further interest rate increases for July and potentially further into the year. We've seen the same signal out of the U.S. Federal Reserve. This all comes as a result of inflation remaining sticky between the 3 to 4% range. Nonetheless, fixed income overall has remained fairly attractive, with yields being range-bound since the start of the year. As we look ahead to the remainder of 2023 and into 2024, we continue to see the risk of economic weakness in Canada as well as the United States. When we couple this with the potential for further interest rate increases out of the Bank of Canada and Federal Reserve, it leads us to favor a slightly more defensive position within asset allocation. We're not afraid of equity market performance through the back half of the year, but rather would work to protect some of the gains that we've seen already through the first half. Our view through the remainder is one of cautious optimism for the back half of 2023.